Hello and welcome to the lecture for part 2 of chapter 15. As I mentioned in my last lecture, this one will be a little bit shorter than the one on long-term debt, kind of fewer moving parts in this area. So here we're going to talk about equity, and as was the case with long-term liabilities, there are larger transactions involved with this, but fewer in number. So it's a little bit easier for us to kind of get our hands around everything in this case. So equity is going to include capital stock accounts. That would be common stock, preferred stock, additional paid-in capital, or paid-in capital in excess of par, whatever you want to call that category or that assertion. It would include treasury stock, which of course is accounted for with the cost method. And then it also includes retained earnings. I'll talk briefly about that. So the auditor's objectives concerning equity, in this case, it's a bit different. Oh, excuse me, I'm a bit ahead of myself. So first we want to consider inherent risk. So inherent risk is going to really derive from the complexity of the capital structure for a business, depending upon how many transactions they have in the category in terms of treasury stock and how frequently they issue stock. If they have different classes of stock that have different rights and privileges associated with them, those sorts of issues can lead to a greater amount of inherent risk versus if it's just kind of a vanilla common stock, relatively few transactions kind of company. An understanding of internal control is required. That in this case, as was the case with long-term debt, the primary concern there is authorization. So is management authorized to engage in the transactions pertaining to equity that they have? And we look at those two issues to inform our risk assessment of material misstatement and how it might affect decisions made based on the financial statements. I can tell you from a user of financial statements perspective that the amount of equity that a company has in particular relative to its debt is a very important consideration in terms of creditworthiness. So what is their debt to equity ratio? And of course, equity is a denominator in that ratio. So inaccuracies in equity can have a big impact on decisions that are made with regard to credit. So some of the objectives that we look at, and here's where I was going to talk about how it's different than long-term debt. So in this case, we're worried about a company overstating their equity, not, as it was the case, understatement being the concern with long-term debt. Here we're worried about companies inflating their equity to make themselves look stronger. So existence is going to be a key thing. Did the transactions that result in an increase in equity over the audit period really occur, and are they justified? There is the potential for overlooking equity issues, so completeness is also a concern, although less of a concern. As with everything else, we're concerned about the cutoff around our year-end date, looking at transactions before and after to make sure they're included in the correct period. Establishing the proper valuation and accuracy of transactions. So there are two issues there. One issue in terms of valuation is if we receive non-cash proceeds for the issuance of shares. As an example, if we issue shares in return for services, say to an attorney, if we issue shares in return for assets that are contributed to the company, the valuation of those services or assets is going to be key in not inflating equity beyond what it should be appropriately. The other issue with regard to valuation deals with stock compensation. And I would encourage you to look back at your intermediate accounting book for a discussion on stock compensation. Lastly, we'll look at presentation and disclosure. And again, that deals with, are we presenting an appropriate level of detail for people to make decisions there? So some internal controls for equity, as I mentioned earlier, proper authorization is key. So in this case, the board of directors and corporate officers are the ones that are going to authorize these transactions. Of course, the board of directors is going to authorize the overall number of shares that can be issued by the company. Corporate officers will make decisions on issuances within that authorized level. So does the company maintain adequate records about which shares have been issued and for which amounts? It's done in two different ways. In large companies, they'll use an independent registrar and a stock control agent. They'll pay outside entities to handle this task. So there are companies that this is all that they do. In some cases, they're the same entity. An independent registrar is an entity that issues new shares of stock, the initial public offerings, that sort of thing, or new shares of stock to private investors. And then a stock transfer agent is the entity that keeps track of ownership of shares. So once the shares are initially issued, then at that point they can be sold between individuals and they can trade hands multiple times. And so a stock transfer agent will keep track of all of those sales so they know at any given point who owns which shares. And they keep detailed records of that, addresses and all of that kind of stuff. So if they issue dividends, they know who to send the dividend check to, who to issue the tax documents at the end of the year regarding dividends, all of that. So large companies will handle it with outside entities, which we'll talk later is beneficial from a source to get information that's third party. It lends more separation of duties if we use outside entities like that. Smaller companies will have generally an actual book of stock certificates with stubs. So the certificate is pre-numbered. It'll be issued to a certain person, torn out of the book, given to that person in return for whatever their contribution is. And then there'll be a record on the stub of what the share number was and the person's name and the date and all of that. I can remember how honored I felt when I was asked to maintain custody of the stock certificate book when I was younger. It was a big deal to have that in a locked drawer in my office. So smaller companies will do it that way. And then we'll look at controls over dividend payments. So again, were the dividend payments authorized? At what level were they authorized? And then did they follow the same kind of controls that exist for cash disbursements in general? So understanding the client's use of equity would start with an examination of their articles of incorporation and bylaws that will talk about the types of stock that they issue, how many shares that they issue, what the rules are with regard to dividends, that sort of thing. Companies will often issue stock at different times. It may be all identical common share stocks. They could have different types of stock. For example, Facebook issues shares to Mark Zuckerberg that have more voting rights per each share than regular shares do. So that's how he maintains control. He has over 50% of the votes that control Facebook, even though it's a publicly traded company. And there are some issues of shares in companies like Facebook and Amazon that have no voting rights associated with them. So there are different types of shares. So for each issue, we'll keep track of the number of shares that are authorized for that particular issue and how many have been issued to shareholders, what the par or stated value is for that particular stock issue, depending upon state law. If there are dividend rates associated with it, if those are preferred shares as an example, and then if those dividends for preferred shares are cumulative or non-cumulative. Again, think back to, I think accounting, probably 301, you may have covered that. If there are call and conversion procedures for debt equity to be changed into debt or vice versa. If there have been stock splits, what the details of those are. And then, as we talked about stock compensation earlier, what options exist. So now on to substantive tests. So we'll obtain an analysis of capital stock. So beginning for all different categories, plus increases minus decreases is going to be the ending balance. So for each of those, we would account for any proceeds. We would find that generally in the cash receipts journal. And then we would confirm shares outstanding. So we could confirm shares outstanding for large companies by sending a written confirmation request to the registrar and our stock transfer agent. So we could get independent, objective figures for shares outstanding that we can tie to the company's records. That's the best way to do it. If it's a small company like the one that I was in where there's a book, we would want to take a look at that book and we would reconcile the information in that book, how many shares have been issued, with the company's general ledger. So we'll determine if the appropriate accounting has been applied to employee stock ownership plans or stock compensation plans rather. A lot of that comes down to determining the value of the options that are given to an employee. So if I'm working in a company that's trading at a particular level, if I issue shares to somebody in the company to buy shares at that same level, then you could make an argument that nothing of value was given at that point. There is quite a complex field of math surrounding valuing stock options. So this may be an area where an outside expert may need to be brought in to come up with a valuation of those if they're significant in number. Then we'll look at whether or not the company is in compliance with any restrictions or preferences that relate to capital stock, and if they've disclosed those. A little bit on presentation and disclosure for equity. So for each issue of shares, so if they have common shares that are A shares, B shares, preferred shares, so forth, for each of those issues, they have to state in their financial statements the par or stated value, if appropriate, the dividend rate, and if it's cumulative or non-cumulative. If there are any conversion or call provisions for the shares, there are, as an example, preferred shares can often be converted to common shares at the shareholders. They can initiate that. The number of shares that are authorized, issued, and outstanding, and the number of shares that are in treasury stock. We would also want to look to make sure that the treasury stock category has been accounted for appropriately with the cost method. If there are any dividends in arrears, and if there are any shares that are reserved for stock options or conversions later. One thing I do want to mention is about retained earnings. One thing that's important for disclosure is if there are any restrictions on retained earnings. So as an example, some loan agreements will restrict a portion of retained earnings so that not all of retained earnings can be paid out as a cash dividend to protect creditors. That would need to be disclosed. Some states require a restriction on retained earnings equal to the amount of treasury stock to prevent a company from kind of being hollowed out by buying excessive shares back. So in states where that's a requirement, that restriction on retained earnings would have to be reported as well. The other subject that deals with retained earnings is prior period adjustments. So if a company determines that a mistake was made in a prior period, they're of course not going to open up the prior financial statement and correct it. So rather than having that adjustment affect this year's earnings, as an example, they would make a prior period adjustment within retained earnings. So a lot of scrutiny is applied to prior period adjustments to make sure that they're being done appropriately and there's not some kind of manipulation. Lastly, the documentation that's required for equity, we'd want a lead schedule of all the equity accounts that ties to the general ledger. For each equity account, we would have an analysis of that. We would keep that in the permanent file so it can carry forward to future years. Any documentation regarding a stock option plan, so we would need those legal documents that were given to people that have stock options. And then we would, in the permanent file, we'd want a list of all the shareholders and their number of shares. So that's the end of the lecture for Chapter 15. As always, if you have any questions, please don't hesitate to give me a call or send me an email. Thank you.